Welcome to Peak Financial Freedom News. My name is Jim Files. I'm your host today, and with me is Dan Ahmed.
Glad to be here, Jim.
We're going to talk about a number of subject matters today. All this information is coming out of our new book that will be released on 25,000 websites here very shortly. These questions start with what retirees need answered in order to comfortably get through retirement. Dan, what are the most pressing questions retirees have today regarding retirement?
Right now, Jim, retirees are asking a lot of questions, and they're not getting many of those questions answered properly. So what we see is that retirees are asking specific items. Number one is, how much income can I safely take out of my assets? They ask, how long will that income last? They want to know, is their income guaranteed for as long as they live? They want to know how they can avoid volatility and losses. They want to know if they start taking income from their accounts, how much income tax they're going to have to pay. They want to know, is it okay to start spending some of their money? They also want to know what happens if the market takes another 20, 30, or 40% dive. What's going to happen to their asset base, but more importantly, what's going to happen to their income? They want to know what happens if they pass away or their spouse passes away. And they also want to know, when they die, what's going to happen when they leave this lump sum of money to their beneficiaries? How much income tax are the beneficiaries going to have to pay? How is it actually going to all work out? And we know right now, unless all those questions are answered for a retiree cannot have a successful retirement.
Yeah, those are all great questions. What exactly does Peak Financial Freedom Group do?
Well, Jim, Peak Financial Freedom Group specializes in providing retirees and soon-to-be retirees the financial services necessary to help them finally attain security. And we're a firm that focuses in markets and works directly with retirees and soon-to-be retirees. Most firms work on what we call the asset accumulation side of planning, and that's before someone retires. A lot of firms help people accumulate assets while they're working all the way up until they retire. We specialize in helping retirees create guaranteed lifetime income plans from their assets once they are retired.
Dan, we did a tremendous amount of research in writing the book. What is the biggest single fear retirees have today?
Well, you know, Jim, retirees have a lot of fears because they're in a new phase of their life. They're no longer working. They're no longer receiving a paycheck. They have to rely on themselves to make all their own decisions. But there is a single biggest fear almost every single retiree has, and that is the fear of running out of money. Every single retiree, no matter how much money they have, whether they have $50,000 of assets or $50 million of assets, they are afraid of running out of money.
And can you explain to the audience what exactly Peak Financial Freedom Group does here?
Sure. Peak Financial Freedom Group specializes in working with retirees and soon-to-be retirees to help them make the best financial decisions. It's not about just investing money. It's not about just deciding on the best portfolio allocation, Jim. It's about helping them make the best financial decisions. And a lot of that has to do with making sure they're never going to lose principal. They're going to avoid market volatility. They're going to have the opportunity to participate in the market upside and a portion of market upside. And most importantly, they're going to guarantee their income is never going to run out.
Well, what causes these fears?
Well, there's many things, Jim, many things. But some of the main areas that causes these fears include market volatility and losses. Because retirees know if they lose money or the market's volatile, it's very difficult to take income out of those types of accounts. They also have not created what we call guaranteed lifetime income. And when you combine volatility and losses with not having enough guaranteed lifetime income, it can cause major issues for retirees, and that's what causes the fears.
And most people entering retirement or in retirement, they have their money invested in the stock market. They have securities, bonds, stocks, etc. How do they avoid volatility?
Well, right now, what we find is a lot of retirees are stuck in what we call the asset accumulation mode. While they were working, Jim, they accumulated assets towards retirement. That means they saved, and they were willing to have their assets in accounts that had an opportunity for upside, but during that same time, it meant they had volatility and the potential for loss. So we call that the asset accumulation side. So when someone's working, they now are going to save assets until they retire. That's called the accumulation stage of retirement. And what happens is their assets have to go through, I'm going to use a red pen, this volatility to get there. And we've all seen our 401k accounts be volatile. We've seen them go up and down. What we have to make sure is that once we get to retirement, we don't have that volatility, because once we retire, can we now take income out of an account that's doing that? Can we take a levelized income stream all the way through retirement when we have a volatile account, and we don't think you can. We think we have to eliminate volatility to guarantee that we're going to have those assets to provide us income for as long as we live.
Well, Dan, if you erase volatility, and I understand that point, how do you guarantee that a retiree will not run out of money during retirement?
Sure, Jim. What we want to do is look at someone with an asset base. And if they have their money in a volatile asset base, and it does this, how easy it is to take a level income stream from that.
Very difficult.
Very difficult, very tough, and that would be the stock market. That's what the stock market has done over the last 15 years. So what we want to do is set an income amount that is guaranteed. Regardless of what happens in the market, I want this income to be paid to our clients every year for as long as they live, regardless of market volatility, regardless of market losses.
Well, Dan, when you enter retirement, the first thing you're thinking about is how do I shore up the difference in my income based on what I've received over the last many years? How long does it take before you can begin taking income out of these types of plans that you're describing here?
Well, in many cases, we can start taking income out immediately. And the reason we're able to take income off of these plans for as long as a retiree lives is that we've eliminated volatility. So let's look at how we can eliminate volatility, and then we'll look at the amount of income someone can take out of one of these types of accounts. If you look at the market from 1999 through 2013, we had a lot of volatility. It was up and down, up and down, and up. That's what happened. During that time period, the market averaged about a 2.75% annual growth rate. That's all the S&P 500 grew by. That's without fees. So if you can imagine, the market earned 2.75%. The S&P 500 index earned 2.75% per year for 15 years from 1999 through 2013 without fees. If you paid 2% in fees, what would a client then net on that type of asset, Jim?
Very, very little. In this example, 0.75%, Dan.
0.75 if you took fees off. So now we have volatility. What we want to do is help every retiree eliminate volatility and eliminate losses, because we just can't have losses. So what's going to happen now is if we invest dollars at this point, when the market goes up, we now get a portion of what the market goes up by, Jim. If you can imagine now, this is called the indexing concept, and it's one of the main ways we help retirees protect their asset base. When the market goes down, the client does not lose any money at all. When the market goes back up, our clients get a percentage of the market. They don't get the full market upside, they get a portion of the market upside, which is fair. If we eliminate market downside, they'll get a portion of the market upside. When the market goes down again, we stay flat. When the market goes up, our clients get a portion of that gain. That's called the indexing concept, Jim.
So what you're saying is that in the years in which the market goes up, you get a percentage of that gain. In years when the market goes down, are you saying, Dan, you lose absolutely none of your principal due to market losses?
Yes, Jim, I'm saying that. Let's assume now in this first year, the market went up, we benefited. Let's say in the second year, the market went down 20%. There would be a 0% interest crediting to your account. The next year the market goes up, we make money. The next year the market goes down 30%. You don't lose anything in your account. The next year the market goes up, you get a percentage of the gains.
That's really neat, because what I see here on your graph here is that when the market goes down radically in any given year, your accounts or these plans don't lose any of the previous gains, and they allow this flat line during that period of time when the market's volatile.
Exactly. We call that a flat line of your losses. And usually flatlining isn't good. It's kind of like if we die. But this is flatlining of your losses. We've eliminated the losses while allowing you to participate in a portion of the upside.
That's really neat. Let me go back to the income side of it. If somebody does want guaranteed lifetime income, if they don't start immediately taking income, if they defer this, does that have any effect on the amount of income they will be able to take out at a later date, Dan?
Yes. In fact, let's look at the different methods individuals, retirees can take money out of their accounts. There's several, Jim. One would be immediate, which is pretty awesome because this means they can take income out immediately from their account. They don't have to wait. They can get their first payments within 30 days. They put an asset base in, they start taking income out. I'll show how that'll work. Then you have a deferral option for those people that want to defer income. They don't need the income right now, but they want guaranteed growth to that asset base to make sure that when they start taking money out 5, 10, 15 years later, it's guaranteed they're going to be able to take more money out. And then we also have a plan that would be the what if plan. The what if plan is pretty good because now that plan tells us either you can use it or your beneficiaries can use it, because a lot of retirees don't know. They literally don't know if they're going to use their assets or if they're simply going to pass it on. And then we'll end the income explanation with what we call increasing income. So there's some really good opportunities for retirees to understand exactly how they're going to be able to take money out. So is it okay if we start with immediate income?
That'd be great.
What do you think as far as most retirees? Do you think a lot of them, when they come in, they're 60, 65, 70, they're going to need income right away?
I think a lot of them will, Dan.
I think they would. I'm going to give an example of someone that came in through our doors a couple weeks ago, and it'll show the power of this type of plan. We had a 60-year-old male come in, and he had $1 million that he wanted to earmark for what we call guaranteed lifetime income. He had $1 million. He had other assets. He had money in the bank for liquidity. He had some money in the stock market for growth. But we looked at his assets, and we decided that $1 million would be needed to provide him guaranteed lifetime income. So $1 million provided him $50,000 of income, and that was then, Jim, guaranteed for as long as he lived. Even if he lived to 120 or longer, it was guaranteed that the 60-year-old, you can imagine, the 60-year-old could take money out of the account no matter what happened. So even if the market did what the market does, guess what? He could take out $50,000 every year for as long as he lived. What was even better, this $50,000 in a lump sum each year could be delivered to him within 30 days of when he established the account.
That's really neat, Dan. What about deferring income, your second one down here? What effect does that have on a retiree's income stream over that same period of time?
Sure, deferring is great because a lot of times you might have someone that retired at 60 and might be working part-time till 65. You might have someone that says, I have enough income now, but I'd like to keep pace with inflation, or have the opportunity to make sure my income was going to increase at some point in the future. And they want to guarantee their income is going to increase. So let's say now we looked at a 60-year-old again. And let's say this individual, instead of putting $1 million in, put in $500,000. And this one will make a female. Client we worked with had $500,000 of assets. In this case now, if they would have started taking income at this point, age 60, their income would have been here. But now if they waited until 61, their income is guaranteed to increase. 62, their income is guaranteed to increase. 63 and 64 and 65. At age 65, it was guaranteed that this particular lady could take out $31,000 a year, guaranteed for as long as she lived. If she waited till 70, Jim, it was guaranteed she was going to be able to get $60,000 a year, guaranteed for as long as she lives. And those two numbers are important because if you can imagine having $500,000 go into an asset, now getting 7.8% of that asset at age 65, do you think she was happy?
I think she's very, very happy. You mentioned 31,000. You meant 39,000.
39,000.
Yes.
And if she deferred it to age 70, she's now going to get 12% of her original $500,000, guaranteed $60,000 of income, guaranteed for as long as she lives, even if she lives to 120 or longer.
That's amazing, Dan, because most people that have a financial advisor, when they ask an advisor how much money they can actually take out of their account during retirement, the common answer that we've heard in our firm is 3.5%, possibly 4%. So these numbers really are extraordinary when you're looking at what you can take out of your account in this example, and the fact that it actually lasts for your entire life. In your example, even if the client lived to 100, 110, or even 120, they will never run out of that money. Is that correct?
That's correct, Jim. What's better is that these income figures and these percentages are contractually guaranteed. They're not maybes, they're not what ifs, they're contractually guaranteed by some of the largest financial institutions in the world.
That's really nice, Dan, and that's really, really neat. And I know in our firm, we have this term called "don't rush the presentation cycle." Can you explain to me what that actually means to the audience here?
Sure. What that means is when you meet with an advisor, typically your advisor is going to try to sell your product in the first meeting. And we don't believe in that. We believe all the information should be gathered. We believe a relationship should be started. We believe we should find out what your problems, issues, wants, and needs are, and then we create a plan over 3, 4, 5, 6 meetings to make sure we are able to provide you exactly what you need for the benefits that you now will have for the rest of your life. What I'd like to also do, Jim, is to look at this what if option, because some people don't know they're going to need the income yet. but they want to make sure their assets are protected, and if they need it in the future, they can use these dollars. So now let's look at another lady that came in. She's 68. She had $525,000 of assets that she wasn't sure if she was going to use for her lifetime. And we said, okay, why don't we look at between 68 and 80? Let's look at 68 and 80, and let's find out what we can do for you. So with her $525,000 of assets, she was concerned two things. One, she wanted to make sure that between now and age 80, she had access to her funds to provide her guaranteed lifetime income, which we could provide her. The second thing, she wanted to make sure if she did not use her money, she was able to leave a considerable amount and a considerable amount more than she had right now to her beneficiaries. So we were able to go out in the market, and there's plans available that would take her $525,000. And if you can imagine, regardless of market volatility or interest rate volatility, we could guarantee that her $525,000, contractually guarantee she'd have over $1 million to provide her guaranteed lifetime income at age 80, or would provide her beneficiaries an amount equal to that $1 million at age 80.
And Dan, that's really incredible. And I'd like to make a point now because you remind me of the clients that we see on a daily basis in our firm. 95% of these clients already have a financial advisor. And every one of these clients think they're paying approximately 1% in an advisory fee to their financial planner or their stockbroker, their investment advisor, in order to manage their portfolios. Of course, this is a completely different type of plan. What we find out every day is that they're paying considerably more. Can you explain that to us to make sure that the audience understands that, Dan?
Sure. I'm going to use a numbers figure. What we find is that most retirees think they're paying their advisor 1% per year in fees. They think they're paying 1%. They've been told that. They've heard it. They've seen it. And in most cases, that part is true. They're paying their advisor 1% in fees. But what they don't know and what they haven't been told is they're paying a lot more fees. They're probably paying up to 1% in a money management fee. They could be paying 0.8 to 1% in fund fees. They could be paying 0.2 to 0.6 in trading and custodian costs, and miscellaneous costs, it could be 3% or higher. I would think right now with the clients that come in, the average fee they're paying is actually 3%. When we show them that, when we look in their statements, when we look in their prospectus, when we show them they're actually paying 3% or 1%, they are livid. They're so mad because they've had an advisor for 20 or 25 years and they thought they were paying 1%. Can you imagine now finding out for sure you're paying 3 times the amount of fees?
Well, Dan, that is incredible. And obviously, I experience that with you every single day in our firm. Can you show the viewers what that really means to a portfolio over a period of time and how that actually affects it? And we call it a cancer within a portfolio. It literally eats the portfolio alive.
It does, Jim. It does. Let's look at a couple and they're 60 years old. And let's say we know they have a high probability, at least one of them, probably 75% probability, one of them at least is going to live to age 90 nowadays, with us all living longer. And let's say now, instead of $525,000, let's say this couple had $500,000 in assets. And let's say they were paying 3% in total fees, which again will be about the average we're seeing with every client that comes through the door. If you can imagine now, they're going to have their assets in this account. Let's assume they just get a moderate growth rate in their portfolio of 6%. So let's say their portfolio grows before expenses at 6%, which seems reasonable, right? Mm-hmm. Seems reasonable. If you can imagine this $500,000 in portfolio, it's going to cost these poor clients $588,000 in fees over that 30-year time period. Can you imagine paying $588,000 in fees on a $500,000 portfolio?
You know, Dan, I should probably say, no, I can't imagine that, but every single day we see this with every single client we deal with. They've had their advisor for many, many years, and they have no idea the amount of fee they're actually paying in order to have their money managed. Also, Dan, it'd be interesting right now to talk a little bit about the way the financial advisory works, or advisor works with this office, because the plan you're explaining here is probably very different than the plan maybe the audience is used to seeing or talking about with their financial advisor. Maybe you can explain why the advisor wants the client to pay those fees and what benefit that might provide the advisor over a period of time, Dan.
Sure. And we call this the business model that a financial advisor might have. So if you're retired at 60 and you have $500,000 in assets, and if this advisor is receiving 1% of your portfolio value every year. As your portfolio grows or decreases, they still get paid. What this financial advisor typically wants is for you to always keep as much money as possible in your account. Because what happens when you take income out is that your account value starts going down and the financial advisor will make less money. It's just mathematics. The more you take out, the less the financial advisor will make. So we find financial advisors and brokers telling clients to keep their monies in the account. Don't take income out now, and don't take increasing income, which is what I like to cover now. I'd like to show you how, instead of telling you how not to take income out, we'd like to show you how you can actually take more money out of your account. And isn't that what most retirees would like?
Absolutely. We hear it every single day. They want to maximize the amount of income they receive out of their accounts for the rest of their lives.
So what we'd like to do, Jim, is show, let's say we had a 65-year-old and we had $600,000 of assets. And the market is going to do this. We know this, right?
Mm-hmm.
We know this. That'll happen. And let's say then just over the next 5 years, this 65-year-old is going to see what happens to their income. So this will be age 70. So let's say with this client, they start with $30,000 of income, and this $30,000 of income for this client can start within 30 days of when they fund the account. So $600,000 goes in. At that point, Jim, we're guaranteed, no matter what happened, we cannot ever take less than the $30,000 out. When the market goes up, let's say the market goes up and our account is credited with an additional 5%, this client now will go up to $31,500 of income. And even if the market goes down 10% next year, our client stays at $31,500 of income. That's the new guarantee for as long as the client lives. It's no longer $30,000. We've now bumped it up to $31,500.
That's really incredible. Well, Dan, what happens if in subsequent years the account goes up, the value goes up by another 5, 6, or 7%? What happens to that $31,500?
Let's say we go up by 10%. Let's give them a big gain. Let's say we had a great year in the market, and the market goes up by 10%. This client would now jump up to $34,650 of income because the market went up 10%. Their payments go up, and at retirement, nothing's more important than getting more income. It's not the asset base. It's the fact that we increase their income. So now the market goes down 20%. Our client continues to get the $34,650 even though the market declined. And they're guaranteed the $34,650 for as long as they live.
And that's really incredible. And let me summarize to make sure everybody's really, really clear on this, because this is a huge benefit retirees have when they're working with our firm. Not only do they get an increase in year one in the event the market goes up in your example, and that increase, whatever that baseline income is going to be, if the market goes down in any subsequent years, they lose none of that income at all, correct?
That's correct. They're locked in.
Okay, and what you're saying is if they have subsequent years and get in the event the account goes up in value, it will also increase income once again?
Again, and then locked in for as long as they live from that point, even if the market falls again at some point in the future.
Yeah, that's incredible. That's incredible. Well, Dan, you know, there's a lot of information you and I deliver to our clients on a daily basis. We call it education. We believe that you can't rush a client through this process because it can be complicated. And we want to make sure at our firm that clients are extremely clear on how these products work and how they're going to work specifically for them. Can you, for the audience perspective, can you give them an example of the cycle that we would take a client through at our firm?
Sure. We are one of the few firms, Jim, that will actually provide the client a written plan. And we believe a written plan is so important to helping a retiree understand exactly what they're doing, when they're doing, why they're doing it, and what benefits they're going to get out of it. So we first start with a written plan. And a written plan is extremely important. Written plan was made up of 4 components. The first component is what we call a retirement income projection. And in the retirement income projection, we are going to show the client exactly what income they should expect every year for as long as they live. It's going to show each year, each income source they're going to receive, when the income sources are going to start, when the income sources are going to stop, when the income sources are going to increase or decrease, so they'll know exactly what they should expect, because no retiree knows what they should expect. And can you imagine going through retirement, hoping a certain amount of income is going to come in, or praying that you're going to get the income you need to pay for your expenses, instead of knowing? We're going to show them on one sheet of paper exactly how their income is going to flow. The second thing we're going to do is a tax analysis, an income tax analysis. Because Jim, I would say anywhere from 75 to 100% of the retirees we meet with, we dramatically increase their income. And when you dramatically increase their income, they get afraid that they're going to pay too much tax. Well, we do a tax analysis for them that shows exactly what income tax they should look to pay, and they usually find out it's not going to be that much to dramatically increase their income. That makes them feel comfortable that they can take the income, pay a little bit of tax, and now have the rest to spend. The third section that we work on is what we call a beneficiary analysis. We want to know approximately what this retiree can leave to their beneficiaries once they pass away, because we all want to leave whatever's left to our kids or our grandkids. The problem is very few of us know exactly how much we're going to leave. I'd like to know and have a ballpark figure of about what I'm going to be able to leave to my beneficiaries, and we want our clients to know so they can make good decisions. And the fourth is just as important. That's what we call plan details. We write out in easy to understand English exactly what a client's doing step by step that will allow them to attain their financial goals. We put this all in one package for them. They'll be able to remember their plan this week, next month, next year, 20 years down the road. The kids will understand their plan. Everyone will finally know what they're doing. And this type of plan in the marketplace, Jim, could cost up to $10,000 to provide. I'm a certified financial planner. I can charge fees for planning. We don't charge our retirees any fee to do this type of planning because we're paid by the companies we represent, so we don't have to charge outlandish fees to our clients, Jim.
That's really, really neat, Dan. That's fantastic. When retired people and soon-to-be retired people come to our firm, they think and there are hundreds and hundreds of different products, and you explain in basic terms the place that people can actually put their money.
Sure. This is one of our favorite exercises because we call it making money simple. And for retirees, by and large, they don't understand money. People that haven't retired, by and large, don't understand money. Money is complicated. It's very difficult. People don't know the right answers. So when we meet with a retiree, we like to tell them that we can actually make money simple. And they don't believe us at first, right? Who believes anyone can make money simple? But we actually can, Jim. We work it this way. We talk about what we call our 3 buckets, and there's only 3 places a retiree can place the money. There's many choices underneath each bucket, but there's only 3 choices. The first is what we call the liquid bucket, liquidity. And in this case, with a liquid bucket, the money can be accessed. It's going to have a low rate of return. It's going to have low risk. And it makes us feel safe. We call this safe money. So what kind of asset would that be?
That would be bank money, or CD money.
Something like a bank, a CD, right? And clients have, a lot of retirees have their monies in here. Then the second category that retirees typically will have will be what we call our growth category. And this will have volatility. It'll have risk. It'll have potential for return. But it'll have also potential for loss, either full or partial. So what would be examples of this category, Jim?
Stock, real estate, maybe a small business.
Stock, real estate, small business. Those are all examples. So most clients we see have most of their money, if not all their money, split between these 2 categories. Someone might come in and they might have $50,000 in this category, and as a retiree, $950,000, including their home, in this category, because homes go up and down in value. They're risky. Yes. Everyone saw what happened in 2008.
Yes.
What they don't realize is that there's this other category. There's a third category. And the third category is probably the most important category for retirees, which we've been discussing, and that is what we call your guaranteed lifetime income category. In this particular plan, you have principal protection, and you had guaranteed income, and no volatility. So this provides security. So if a retiree can place monies here, in this case, how much money do you think the typical retiree would love to put in this pot?
Well, we see it every single day. They like to put the majority of their money in that pot. Obviously, we can't and we don't do that. But when they see that level of safety, they become very, very excited.
Exactly. They might have $250,000 of real estate in their home. They might have $100,000 in a small business, which will leave then $600,000 in stock in this case to make up their $950,000. So in this case, we might say, let's take out $500,000 from their stock and place it here. And now they have $100,000 left in stock. And now $500,000 that can provide them income for life. And if they're married, Jim, they can actually take out joint income for life that's guaranteed to last for as long as the husband lives and as long as the wife lives.
Dan, just to make sure that the viewers understand this, since you took $500,000 out of the securities bucket over here, the growth bucket, and you put that $500,000 over here into the guaranteed lifetime income bucket, the client, based on our understanding and the way this works, explained to the viewers that they still are able to participate in the stock market.
Sure, Jim. The main key of this particular category is, of course, guaranteed lifetime income. But at the same time, we also are able to deliver the potential upside of the market because we're not locking the funds up where they can't be accessed. The funds are still available. We're not losing the dollars. We're not giving up the dollars. We're not losing control. We still own that asset. We just have an income guaranteed for life attached to our plan.
One major questions that retirees have when they meet with us is that once that money is in that bucket and downstream when they do pass on, maybe you can explain to the viewers what happens with that money.
Sure. A lot of old plans that provided income guaranteed for as long as someone lives really took control of those assets. The individual, the retiree, lost the control of those assets, and if they passed away, assets might or might not be passed on to the beneficiaries. And if retirees are like us, we love our children, we love our grandkids, we want to leave whatever's left to the beneficiaries. All the plans we work with will provide a guaranteed lifetime income to the retiree, and any money, every single dollar that's left in that account when the retiree passes away is passed on to the beneficiaries, whether it's their spouse, their kids, their grandkids, their great-great-grandkids. It could even be passed on to their charities if they like.
That's really an important point because as we deal with soon-to-be retirees and retirees every single day, that's a big question they have. They love the idea of having guaranteed lifetime income. They love the idea to be able to get raises to help offset some of those cost of living incidents that we'll experience over our lifetime. But also they cherish the fact that whatever's left in the second bucket can be passed on to their children and or any other beneficiary.
That's exactly right, Jim. Retirees worry about their assets now. They do not want to lose any of the value to market volatility or losses. They also want to make sure they can get the income they need between now and the time they pass away, regardless of market volatility. If possible, they'd like to receive raises on their income if the market goes up. And just as importantly, they want to make sure whatever's left in their account is passed on to those beneficiaries.
We might want to talk a little bit about the cycle that we would take a client through at our firm because money is confusing. You mentioned that earlier. We talk a lot about that in Don't Bet the Farm, our book. Maybe explain to the audience because, again, we want to make sure that our clients are highly educated and when they come in, money is scary to them. They may not know a lot about money. Explain the process we go through, Dan, with a retiree or soon-to-be retiree when they meet us for the first time.
Sure. When we meet with a retiree, we first will find out exactly what a retiree wants and needs. And we need to know what they have as far as assets. We need to know what they also have as far as debts. We need to know what their income needs are and their expenses are. But more importantly, what we ask retirees is not what do they want to do with their money. We ask them what do they want their money to do for them. And that's a whole different question because what do you want to do with your money means where do you want to put it? What stocks do you want to buy? What mutual funds do you want to buy? How much risk do you want to take? That's what do you want to do with your money. We want to know what retirees want their money to do for them. Do they want their money to be in a safe place? Do they want their money to provide them income and at what level? Do they want their money to last for as long as they live? Do they want their money to provide for their spouse in case they pass away? Do they want their money to be left to the kids when they ultimately pass away? Do they want their money to allow them to take those trips to Italy, to Spain, to Paris, to Australia, Do they want their money to allow them to buy that new car, buy that new motorhome, do those home renovations, buy that new diamond ring, all the things they need, help their kids with education or buying a house? What do they want their money to do for them? Do they want to leave money to charities? We want their money to feel like it's under their control, not like the money is controlling them. So we go through a very specific process where we find out what do they really want to happen. We then will gather data. We'll start putting ideas together, some what ifs. We'll ask the retirees, what if we could do this? Would this be something you'd like? Or what if we could do this? Would this be something you'd like? And then we'll start putting together draft plans. We'll meet with them on a second or third appointment and present what some of our ideas are. So the client doesn't have to move forward. They're just our recommendations and there's some ideas. And then we really find out on that second or third appointment what avenues we should start heading down. What's going to fit for that individual retiree, that individual client. We start putting the plan together. We'll finally agree with the client that this is the plan. And then typically on the fourth or fifth appointment, we finally will implement a plan. And that could take a month and a half to actually implement. So there's no rush to what we do. And it's done with care, consideration, and a lot of thoughtfulness.
Well, that's great, Dan. I think today, hopefully, the audience received a lot of good information. Don't Bet the Farm, our book is over 400 pages of comprehensive information specifically for soon-to-be retirees and retired people. And for those folks that are interested and want more information, we deal with clients every single day around the country. Our number is 916-791-7063, and our website is www.peakfin.com. And on the side of the screen that you're looking at right now, if you fill in the information and select the option you want, we will get back to you and get you either content, in other words, information, and or we'd be happy to talk to you. So Dan, I want to thank you today for going through and answering all these questions, and we surely would like to thank the viewers for the attention they've given us today in their time.